Nice to have you with us once again. Joining me in the studio this time around is Warren Ingram, a certified financial planner and director of Galileo Capital, and also Herschel Jawitz, who's the CEO of Jawitz Properties. You've probably guessed by now that we are going to be looking at the property market, but specifically looking at where the market is and whether you should be in a rental or a buying situation right now. Thank you very much, gentlemen, for your time. Nice to have you with us. Warren, where do you reckon the market is right now?
In terms of residential property, I think it's starting to unlock. You know, maybe a year or two ago, you wouldn't see as many deals as we're seeing now. I'm sure Herschel will have a different view. But I think I'm starting to see more and more of our clients who've wanted to sell property actually getting the property sold. Whether those properties are being sold at a higher price than they were a year ago, I don't think so. I think it's just that a year ago maybe the deals weren't happening, and there are more and more deals now. But to me, it doesn't feel as if the market's suddenly, you know, shooting ahead again. It's not. It's still reasonably quiet, but there are transactions.
Herschel, would you agree?
Yeah, that's probably a pretty accurate assessment. So, you know, depending if you're a buyer, a seller, lessee, a lessor, but I think for all four parties, the market's in fairly reasonable shape. We're definitely seeing more buyer activity than we've seen for a number of years. I think buyers have a sense that properties are fairly priced, interest rates are still at historic lows and look like being at that level for some time to come. So the buying opportunities are good. I think sellers are seeing more activity. They're probably seeing more sold signs going up. Prices are moving gradually, so maybe 4 or 5% in some areas, at least with inflation. And I think similarly with the rental and the investment market, I think that it's in reasonable shape, and investors are getting a decent return, and tenants are paying a reasonable price for rental property. So I think this is the first time that for the market as a whole, it's in reasonable shape.
I'm picking up a sense here that it's sort of evenly weighted at the moment from a rental and a buying position. We were talking before we went on air about Professor Veruli's sort of 10-year cyclical number that he keeps coming up with in the property market. That's got about 5 years to run. So we're sort of in the trough at the moment. If there is cash around, I would imagine now would be a good time to actually be diving into the market and buying up those properties before they start accelerating on the back end of that cycle.
I mean, I have two counter problems here. One is I think interest rates, when they start going up, and none of us know exactly when that's going to be, surely not in the next year or so, but when they do go up, that tends to be bad for all properties. You know, rising interest rates are never a good sign for property buyers. The problem, though, is in this instance, rising interest rates will mean that the economy is recovering. It means that we're starting to try and control inflation again, and that will be a positive sign. It's probably one of the few instances where, you know, rising interest rates is actually a good thing, and we should be smiling about it.
Yeah.
So for me, I'm probably not going to rush into residential property in the next year just because the market's unlocked. I think I would still want to see other things happening as well. I'd still want to see demand rising a lot more than it has for now. Although, I mean, in any market there'll always be bargains, whether it be the share market or the property market, and that will apply today. But I wouldn't say just on a big view, at a big picture view, that yes, you know, now is a screaming buy, and a year's time you're going to regret having not bought now. I mean, I think in a year's time prices might still be roughly where they are now.
But I mean, Herschel, shouldn't people be factoring that in? Because I mean, I remember, and I'm giving my age away now by saying it, but I remember when interest rates were sitting in the 20%.
Yeah, late 90s.
And people had bought at an interest rate of 16%, and suddenly it was up to 22%, and they were actually having to offload their properties. Shouldn't you be factoring in an interest rate of, say, I don't know, what, 10, 12%, and saying, can I afford the payments on that? If so, if I've got the money now, let me buy the property.
Yeah, I think so. I think if you're not going to factor those increasing interest rates in, the banks are doing that for you. So I think that's one area we've seen the banks really tightening up in terms of the National Credit Act. They're not only looking at your gross income, they're looking at your disposable income, and they're certainly factoring in increase in interest rates and looking at your affordability. But I think a couple of factors. You know, I think your clearly investing in residential property is part of a portfolio, equity, stocks, bonds, and where you are
part of a mix.
Part of a mix. But I think your average investor at the moment, if you look at, especially sort of in the lower price ranges up to about $1.5 million, with interest rates where they are, and depending on how much you put down, the cash flow impact of investing at the moment at those sorts of levels is very positive. Interest rates are low, so generally your rentals are going to cover at least your mortgage repayments, and if not, at least a significant portion of your rates and taxes. So for a lot of investors, up until that level, you're probably at least cash neutral. You're not putting in money after earning your rental and paying your mortgage and paying your costs of running a property. And your yields, with property prices relatively stagnant and rentals sort of increasing at a faster rate than what property prices are, your yields are going up. So should you put all your money into residential property? Probably not. But I would say that most of the people I know, including myself, at some stage look back and say would have, could have, should have, didn't. And as long as you're taking a long-term view, investing in a residential property, I think generally it's a good time to invest.
What's that smile about now?
Yeah. No, I mean, I think it's one of those things that's for me, it's always a difficult market to understand, because I would compare it to buying property companies on the stock exchange, or if you're taking a view on property and it's such a concentrated investment in one property in one town at the tip of Africa, as opposed to saying, well, let me buy even an index, a property index, which is spread across thousands of properties across many cities, and I don't have to pay massive transaction costs. I don't have to maintain the thing. I don't have to manage tenants. So, I mean, I think buying a house is one thing to me. I understand that, but buying it as an investment is always for me a tricky one, because in effect you're making a business decision. You're actually saying, I'm now going to run a business. I'm going to manage tenants. I'm going to maintain the thing. And the costs I always think are high, and that's the thing I find uncomfortable. That was why I was smiling.
Okay, but then let's look at, for example, the commercial property market, which has been taking off over the last 2 or 3 years. There's been some great returns in that particular sector.
Yeah.
Is it not the time for the residential market to start ticking over and starting to pick up and seeing some returns?
Well, I mean, I look at residential property, and I agree with Herschel. It's a very long-term investment. You have to take that view. And for example, there's a fantastic index that tracks property prices over 400 years in the Netherlands, and it's house prices in one area. And over 400 years, house prices have moved 0.5% a year above inflation. So if you're asking me about where house prices are going to go over a 20 or 30-year view, certainly in our country, they've moved by about 2% a year above inflation. That's the ABSA house price index from 1966 to now. So I can't see in my mind why it will suddenly shoot 5 or 6% a year above inflation. Whereas I think commercial property is different in that we didn't really have a commercial property market of shares that you could trade in the late 90s. I mean, it just started then. Before then, Anglos, Old Mutuals, breweries, Sanlam, they all owned all the properties. So to me, part of what we're seeing now is a normalization of an artificial situation. Our property market, our listed property market is now kind of how it should have been 20 years ago. And I think our residential property market, to me, that correction happened in the 90s. When, that was when the people started buying houses in all areas. So I can't see why suddenly that will now follow again next year or in the next 5 years. I can't see a driver for that.
Okay, let's take Warren's standpoint there, Herschel, and try and flip that.
Yeah.
If we say, fine, since the 60s, the residential market has beaten inflation by 2%, it's a comfortable return on your investment, yeah, but you're outlaying a lot of money up front. Yeah. Why would I want to then get into the market and buy a second, third, fourth property for rental purposes? What's in it for me there? Come, convince me now. Be the estate agent.
You put him to rest.
Yes, yeah. Bury him.
Listen, so, once again, firstly, it is a long-term investment. Secondly, and I say this carefully, you know, I'm not...
Actually, any investment should be a long-term investment, whatever you're investing
yes, it should. Listen, if you're investing in blue-chip shares, buy the shares, put the certificates in the safe, and leave them there for your kids and your grandkids.
Yeah.
I think, and I say this carefully, that residential property is one of the few investments that allows you to gear yourself to the extent that you can. Now, that got a lot of people into a lot of trouble during the boom when people were sort of flipping properties and buying properties with no deposits. But it does allow you to buy a R1 million investment, as an example, with only 50,000 Rand down. And I say that carefully. Don't rush out with your credit card and use that to invest in residential property. So it does allow you to gear. And if you look at people who've built up portfolios over a period of time, one of the positive aspects is that once you've built up equity in that investment, so you've paid down your bond to a level where there's equity relative to the value, it allows you to gear up again and reinvest, whether it's in residential property or in other areas. So it does allow you that gearing. There is relatively lower risk than investing in, for example, the equity market, albeit at a lower return. So once again, you know, depending on where you are in your life, whether you're looking for stability of income, less volatility, more risk, it may be suitable at different periods of time. And I think that there are, and especially when you look, I mean, we see more and more investors in the market, and when you talk to them and say, you know, why are you buying 2 and 3 properties? I think a lot of people, it's not without danger, but a lot of people actually say, you know what, I want to invest in bricks and mortar. I don't want to have some fund manager looking after my money. I want to be able to feel the bricks and mortar. I want to be able to collect the rents and manage my own investments. You can choose to take on a property management company. Yeah. So I don't say that you know, there's a uniform rule, but there is no doubt that there are a lot of people over a lot of time who have done very well in residential property, and I think that it continues to be a sustainable and a good investment over a period of time. And in times where interest rates are higher and the values may drop, remember, you're also getting a yield on this. You're at different times, you may be getting a better yield and better capital growth. But I think that there are very few people over time who look back and say, you know what, bad investment. I've paid down my unit. I'm earning rental. It's part of my retirement income. I've got a capital asset that I can sell if I need to sell it over a period of time. So I think, listen, you know, there are always going to be arguments forward and backwards, but you know, those would be the key areas for me.
We're going to a commercial break. Has he convinced you to buy a property yet?
No.
We'll come back and find out why in just a moment. Whether it's best to buy or rent, we'll dig down into that in the property investment climate. Don't go away. Welcome back. We're chatting to Warren Ingram, a certified financial planner and director of Galileo Capital, and also Herschel Jawitz, CEO of Jawitz Properties. Looking at the property market at the moment, and one of the questions is whether it's the time to be buying in the residential market or maybe renting, and we haven't really dealt with the renting side. We'll move on to that in just a moment. Before the break, though, Herschel gave a hard sell there on residential properties and why you should be buying into it. Warren, you're not convinced. Your reasons, once again, you'd rather go for the stock and spread the...
Yeah, my concern always is, I think I agree in terms of it's one of the few ways that you can borrow money to invest. And yes, I mean, borrowing money to invest is not always going to be the best strategy for most people. And I do think there are fantastic examples of people who, over many decades, have built real fortunes on property, you know, with borrowed money. So there is definitely an argument for that. My concern is that is a small portion of people that can actually do it effectively, that can do it...
Who are those people? Who are we talking to here?
My feeling is it's people that are innately conservative with their own cash flow. In other words, they know how to manage their own money. They know how to protect themselves against unforeseen events. So, I mean, the nightmare scenario for me would be the person who's earning a good salary and decides, okay, I've paid off my house, I'm now going to borrow money to buy another property and I'm going to rent that out, and they lose their job. And they've got a bond, and then the tenant decides they lose their job, and now you're stuck. So that's the nightmare scenario, and I'm not by any case saying that that's going to happen to everybody, but it's those people that haven't catered for that kind of an event. So people that can say, right, I've got cash flow to fund a bond or 2 bonds, for that matter, for 6 or so months, if the worst of the worst happens, and yes, I can sell the property if that really is the situation. Those kinds of people, when they're smart and they manage their cash flow carefully, they can do it well. But we all know people don't even save. People don't manage their cash flow properly. So it's a very small portion of our population right around the world that can do it effectively at low risk. And that's my concern, is as soon as it goes against you, you've borrowed money. And now the risks are huge.
Okay, but then having said that, and Herschel, I want to flip it back to you in just a moment, but I want to stick with Warren here. Having said that, there are people around. Let's create a scenario here. Let's say that I have saved money. Let's say that I have a R1 million in an equity portfolio, and that's performing. It's ticking over. It's invested in your Satrix 40s or whatever. It's a fairly defensive portfolio. And I see a property which I think is a damn good price, and I've got a spare 50,000 rand.
Yeah.
And my property is paid off. And I go, okay, I'm going to buy that for R1 million, because if the unsaid word hits the fan, I can liquidate that R1 million to pay off the R1 million debt.
Yeah.
So I don't have any debt. Should I maybe then be looking at it from a different perspective there?
I think it becomes more viable. I mean, certainly. I think my comment to you would be that you need to at least be sure that once you've paid your transaction costs, once you've put down your deposit, you've still got the ability to pay off that bond for 6 months if you don't have a tenant.
Okay.
That would be the starting point in my mind. Why 6 months? Because it takes a while to get rid of the tenant who's not paying. It takes a while to then find a new one, and before you know it, 6 months is possible. So I think that's one aspect, and then I mean that might be a case. What I would say, as if you were, I mean, and I would say the same thing to somebody who decides to go and buy their own shares. Not a bad idea, but make sure you've done your homework. You can't just buy a property because you've seen it and your mate at the Braai said this is a good one. That doesn't help you. You really have to have done your homework, and you have to treat this as if you were making a R1 million purchase, not the 50,000 rand deposit. It's a R1 million purchase, and it's a purchase you're going to make for 20 years. And then, if you're happy with that, and you take that kind of approach, then why not?
Okay, I'm in the market now.
Yeah.
You've convinced me. Warren is playing. Warren is. I'm going to call Warren my wife, okay? Because Warren is behaving like my wife right now. Okay, no, you can't do that because we haven't got that and we need that. Okay, so Warren's my wife, and you're my lover on the side.
Right.
Okay.
You want to swap? I don't know what
You've convinced me. What should I be looking at if I want to invest in residential property from a rental point of view? If I'm buying to rent, what are the boxes that I need to tick there?
So I think, and listen, let me just say this. I mean, whatever Warren has said about the issues around affordability, making sure that if...
Now leave my wife out of this.
Yes, right, so your wife, right.
Yeah.
So that's the starting point. You've got to say to yourself, you're in a position now where you can start to invest. You've got some disposable income, you've got some... as much as you can, some security of employment. There's now an opportunity for you to take some of your disposable income.
It's a big word.
Yeah, disposable income. Not that we're going to have to cut back and we can't do this and we can't do this and we can't afford this. And I'm not talking about luxury holidays. Those are... But you've got some disposable income that you can use to now invest. That's the first thing to do. Right. The second thing to do is you've got to start doing some of your own research in the market. And unfortunately, the residential property market, it's not shrouded in mystery, but access to real-time information is difficult. It's not like the stock market. So there's transfer data that you can get hold of. But transfer data is about sales that have taken place 3 or 4 months ago. So you need to do some of your own research. Go onto websites. You need to go and talk to your local estate agent. You need to be looking at areas where, for example, there could be sustainable rental markets. So if you look at the Sandton area, for example, which is the business hub of this country, generally there's going to be a more sustainable rental market, albeit that you're going to pay more for property. So you need to have a look at what you can afford. You also need to have a look at then what kind of rentals are available and why people would rent in that area. Is it student accommodation? Is it for business purposes? Is it a corporate market, for example? So you need to do a fair amount of homework, because you don't want to end up in the scenario that your wife mentioned, where you buy a place and I've got used to that, and for 3 or 4 months there's no tenant, or you suddenly find that the rental is not going to be 6,000 Rand a month, it's only going to be 3,500 Rand a month, and you're out of pocket for another 3 grand a month or 4 grand a month, and you can't afford it. So those are the real issues that you need to look at it from a sustainable rental point of view. Who would rent in that area? Why would they rent in that area? And then when you look at the purchase price, you need to try and factor in how much you can put down, what would your monthly repayments be, and what portion of those repayments would be set off against the rental, and what can you afford with the rest. So don't rush into it. Those are sort of the key areas to look at.
Why would you buy if you can rent? Why would I take 50,000 Rand out of my back sky, put it on the table, and be bound to a bank for the next 20 years, paying them a certain amount of money on the bricks and mortar, when I could actually just go out and for more or less the same amount of money rent, and if I don't like the place, or if I have to move tomorrow, or decide that I want to go and live in Cape Town, I could just pick up the phone and say to the landlord, cheers, China, come pick up the keys, I'm out of here.
Yeah. So you, I mean, you're talking to someone who has done that most of his life.
Right, so talking to the right person.
And the only reason why we ended up buying a house was because my wife wanted to work on her own garden. And
so you've got your own wife as well?
I've got my own wife.
So you're cheating on me?
Yeah, polygamous. So I mean, my view is that if you... I mean, we kind of ran a whole lot of numbers to try and see when would it make sense to rent and when would it make sense to buy, on a pure doing it for yourself case. In other words, not renting it out to someone else, just when does it make sense to buy your own house. And if you take things like the transaction costs of the property, the maintenance costs and those kinds of things, then if you rent a property and you stay in that property for 8 years or longer, or as opposed to then buying the property and staying in it for 8 years or longer, it actually does make sense to buy the property. So you need to be as sure as you can be about anything that you're going to stay in one place for 8 years or longer.
Where does the 8 years come in?
Why 8 years applies is because when you've now signed a lease agreement with the landlord, he's going to put in a rental escalation. He's going to tell you every year your rent's going to go up by at least inflation. Often they don't want just an inflation increase, a little bit more than inflation. So if you look at that rent going up year after year after year, as opposed to your mortgage repayment, because remember, when you're paying back your bond, the only thing that's going to impact your bond repayment is either you putting in money or interest rates. Okay. So over 8 years, it's likely that your mortgage repayments will stay flat if interest rates stay flat, but your rent would have gone up year after year after year.
Okay.
After 8 years, then staying in the house, you would have spread out those transaction costs. The gurus call that amortization, but for our view, just spreading those costs out, then it makes sense to actually buy the house. The problem is most people don't stay nowadays. Most people don't stay in one property for 8 years. You know, the classic sort of cliche is, you know, the husband and wife get married, they have their first kid, so they buy their first house, then they have their second kid, need a bigger house, they buy another house. Then they get to retirement stage, the kids are out the house, they buy a smaller house. And all of that stuff doesn't always happen in 20-year blocks. So that's the one problem, is you need to be in that house for at least 8 years in my opinion.
What's the market doing? I suppose now's a pretty bad time to be discussing that, because I would imagine with the pressure on people from a monetary point of view and the fact that rates are low, people are not tending to make any change now. But what is the cycle? Is it less than 8 years that people are moving in and out of properties?
It's probably more or less 8 years, you know, so I think that it might just push out a little bit now, but I'd say generally 7 to 8 years is a good rule of thumb. I think the issue is this, is that, listen, you know, can you predict where you're going to be in 8 years' time?
No.
Probably not. I think that the one area, and this is specifically around a home to live in, which is very different. When you're buying a property to invest in, you invest like you're investing in shares. There's no emotion in it. You invest in it not that you're going to live in it, that someone else is going to rent it. But when you're looking at buying your own home, you know, I think that you can certainly talk about spreadsheets and running numbers, which 99% of people in this country can't run a spreadsheet on how to amortize renting versus buying. But I think that you're also looking at some of the softer factors around your own home, around the social issues, around a roof over their head, around aspirational issues. And listen, you know, without turning this away from a financial decision, you know, that kind of stuff is what roots communities. And you only have to look at what's going on in this country to understand where people don't have roots and people are living in shacks and all of the stuff that evolves out of that, and none of it is good. So, you know, the social fabric of any community anywhere around the world is rooted in land ownership and home ownership, and I don't think that you can start to discount those issues, aside from the fact that simply, why would I want to pay down your mortgage bond, irrespective of how long I amortize it over, when I can pay down my own property and build some equity up in the process?
Well, I think what's coming out here is it's all an emotional decision, and if you can strip the emotions out, then maybe you can make some headway in this particular market. It's as simple as that. Gentlemen, thank you very much. We're out of time. Lovely to have had a chat with you. That's all we have time for. Remember, if you have any comments, queries or suggestions, you can email us at moneysense@abn360.com. From me and the team, we'll see you again next week. Bye-bye.